This next segment is brought to you by Fisher Funds. We wanted to answer some of the questions many New Zealanders have about KiwiSaver, and today we are talking about how your KiwiSaver is invested. We're here to discuss the Senior Portfolio Manager, Global Equities, Sam Dickie. Morning, Sam. Thank you for being with us.
Good morning.
Okay, so how is KiwiSaver accounts different to a savings account?
So a KiwiSaver account is an investment. So when you or I invest in KiwiSaver, that money ends up in a managed fund, which is managed by a professional fund manager who, on our behalf, will invest in things like stocks and bonds and property. So unlike a savings account, the value of a KiwiSaver account can go up and it can go down over time.
Yeah. Okay, so you're talking about the things that are invested into shares, property and bonds. Do they have the same return and risk?
No, they don't. So take bonds, for example, that they are typically associated with lower return over time, and that comes with lower risk.
Yep.
And shares, for example, have typically higher return over time, and that comes with typically higher risk. So to give you a couple of numbers there, Jenny, if we'd been lucky enough to invest in the US bond market, say 50 years ago, we would have made, on average, a 6% return per annum, which all added up together makes about 20 times your initial investment. But on the other hand, if we'd invested that money in the US stock market 50 years ago, we would have made about twice that annual return, so about 12% per annum, which, when we use the power of compounding, the eighth wonder in the world, as Einstein said, that comes out to about 200 times your initial investment.
I guess the other thing that we have to be mindful of is the fact that, you know, your funds will go up and down, right?
That's right. So unlike a savings account, the value of your KiwiSaver account can go up and it can go down over time.
Okay, so when we're looking for shares to invest in, what are the things that we need to be looking at?
Yes, Fisher Funds is a focused fund manager. So what that means is there's more than 50,000 companies or shares listed globally, and we've handpicked less than 100 of those. So really important, as you say, to have a specific set of things we're looking for when we build an investment portfolio or fund. So three key things we're looking for. The first one is a wide economic moat around the business, so competitors can't jump over that moat and kind of attack the castle or attack the business, so to speak. And a good example of that is Fisher & Paykel Healthcare. So they've got more than 50 years of know-how, of expertise, of R&D tucked away. So you and I, for example, Jenny, couldn't jump over that moat and compete with Fisher & Paykel Healthcare. Yep. The second thing is a long runway for growth ahead. And take cloud accounting software player Xero. There's hundreds of small businesses around the world, and we think less than a quarter of those have a cloud accounting package like Xero. So that's a long growth runway ahead. Yep. And the final thing is we want these businesses to be run by, you know, highly talented, highly passionate, highly aligned people. And to steal a quote from Mainfreight, special people, special company. So there's tons of things that investors look at. Those are the three key things we look at. But if you are down a random aside here at the field days at Mystery Creek next week, we'll be there, so pop in and say hi.
Gosh, yeah, field days next week. Sam, thank you for popping in this morning. Sam Dickie, Senior Portfolio Manager, Global Equities, Fisher Funds, joining us this morning. Thank you.
Thank you.